Everybody, Bruce Brown with your daily mortgage market update. Today is Thursday. Once again, we go to the mortgage bond chart. You can see that mortgage bonds clearly really doing quite a bit better today. In fact, this resistance that we had at 102.30, we have broken above that resistance. We're now at 102.47. We're able to stay above this resistance and close above this resistance. It will then, as I've been talking about the last few days, become support. And this would be a nice little floor of support to give us the opportunity to potentially bounce a little bit higher, get to some higher mortgage bond pricing, which would take us back down to some slightly lower rates like we've seen over the course of the last week. Since bond prices have been falling, we've seen rates creep up very, very slightly. But really, all hinges on tomorrow and this jobs report I've been talking about all week. Now, let's go ahead and take a look at the economic calendar for today. Initial jobless claims, as they are every Thursday, were released today, coming in at 312,000, basically right in line with expectations. Last week's number was revised very slightly upward from 300,000 to 304,000. So, all in all, another pretty strong, I would say, good initial claims number. And most economists, investors, what they actually look at is the 4-week average, the 4-week moving average on the initial claims. That's the real number they watch. And I want to take you down and I want to show you where we're at right now on the 4-week average here. The 4-week moving average has dropped now to 310,000. This is the lowest 4-week moving average that we have seen since the economy started improving. So you can see this average has been coming down very, very slightly, and so now we are at a recovery low on 4-week moving average. Now, the important thing to talk about with this, and one of the things that's going on here, yesterday, as I talked about, we got that ADP employment number, and it came in at 179,000, well below the expected number, expectations. And this has kind of set the tables now for the market to think that this report tomorrow, with an estimate of 220,000 jobs being created, may actually not happen. And if, again, as I mentioned yesterday, folks, the way this works, this jobs report is probably the biggest driving factor of where we see potential for interest rate movements on a month-by-month basis. This payroll report has so much to do with the strength of our economy. More people back to work, increasing payrolls, lower unemployment is good for the overall economy. And so that when you get the economy starting to pick up steam and start to go full steam ahead, that actually hurts mortgage rates somewhat. But that's not a bad thing because we want interest rates to still be at decent levels, but we want to have a much stronger economy. Well, what we saw last month was we saw a really strong jobs number, 288,000. But we also saw an unemployment rate take a dip to 6.3%. But the devil is in the details, as we talked about last month. The reason for the drop in unemployment has everything to do with our labor force participation rate shrinking. And as fewer and fewer people are actually out there looking for jobs, people who give up, people who have run out of long-term unemployment benefits are no longer counted as being unemployed, although they are still unemployed. And this is where this big issue comes in, folks, and this is what's really, really important to talk about, because tomorrow, if we have another one of these jobs reports where we have either weaker than expected jobs growth or we have a unemployment rate drop, and if the drop is due to continuing shrinking in the labor force, or if we see an increase in unemployment because the labor force participation rate's getting back to maybe a little bit better, but the unemployment rate goes up, I think traders are starting to set up for maybe a jobs report tomorrow that might not be so bad for interest rates. In other words, I think that the markets are probably thinking this jobs report tomorrow may not be so hot. And if that actually happens, we potentially could go back and see interest rates, or I should say mortgage bond prices, go higher, which will lead to interest rates coming back down. A lot hinges on this jobs report tomorrow and whether or not we're going to continue to see this rally in interest rates that we've seen over the course of the last couple months continue. So remember, as we just look at this chart, what we're looking at right here is the last 3 months of mortgage bond pricing, and you can clearly see that we are on an upward trend. We are in a channel going up. As we go up, we also come down from time to time like we've seen here. But as I said earlier this week, this decrease we saw in bond prices I don't think is a bad thing. It's a healthy thing. If we're going to continue to see things rise, the markets have got to get behind it, and it's got to be data driven. And right now, tomorrow's data will be very, very important to whether or not we will be able to continue to see an improvement in mortgage bond pricing and interest rates coming back down. Now, on the flip side, we have to talk about the potential tomorrow that the opposite happens, that we get a stronger than anticipated jobs report. If that happens, We have support here at 102. We have another support at 101.60. And then we're going to have some support even further down here at the 100-day and the 200-day moving averages. How far mortgage bonds could fall really would just depend on how strong that jobs report is and what it really meant moving forward. But what we see so often happen when the jobs data is released, and it's going to be released in the morning before mortgage companies price, before interest rates come out tomorrow. This data will already be absorbed in the market. A lot of times what you see is you'll see a big knee-jerk reaction to the headline numbers, and then you'll see the market move one way or another strongly after the details are known, once they actually read the BLS, the Bureau of Labor Statistic report. So we have to be very wary tomorrow that we could see some real volatility. But again, everything really hinging on what this payroll report and what the unemployment rate numbers actually come out to be. So what we're seeing today is we're seeing some nice improvement in mortgage bonds. We've bounced off the lows that we've seen so far over the course of the last couple of days. This could be a sign of better things to come, but we've got to get past tomorrow first. This is where we are heading into tomorrow. I will be back with you tomorrow morning to give you an update and let you know just how the jobs report not only shakes out, but what the mortgage markets are doing in reaction to that. Hope everybody has a wonderful day, and as always, if I can help you in any way at all, please don't hesitate to contact me, as all of my information will be here at the end of the video.